Justine, mute your mic.
Right, good morning everyone, and thanks very much for joining us this morning. I hope that you're all keeping safe and well in these challenging times and that you're doing okay from a business sense. My name is David Warnicker and I'm a tax partner at BDO. In this morning's webinar, we're going to look at some very specific issues and some general issues. We're going to look at specific issues regarding the COVID-19 relief bills that have been put out for public comment. But we're also going to consider more general issues that are applicable to businesses that are going through recessionary times, such as what we're currently experiencing. And of course, it's important to be aware of these different issues because certainly with the relief, one can take advantage of that. But with respect to the other issues, maybe one can plan one's affairs accordingly so that one doesn't fall into a bad place with regard to those. And before I introduce the speakers this morning, we've got a very good panel of speakers this morning. I just want to go through some basic housekeeping for the webinar. And the first thing is, if you could please use the Q&A function on Teams if you want to ask a question. We'll take questions at the end of the presentations altogether, so not at the end of each speaker session, but rather at the end of the whole thing will be when we look at questions. That Q&A functionalities, those of you that are not that familiar with Teams, is if you hover your mouse towards the bottom of your Teams screen, just on the left of where it says request control, there's sort of a speech bubble with a question mark in it. And that's where you'd type your question in. So not on the chat facility, which is further to the left, but the speech bubble with the question mark in it. So if you could use that, please. And we have set time aside. We should have time to take questions at the end of the presentations. The webinar will be recorded as well and will be made available on our website by Wednesday, the 13th of May. So if you miss part of the session, you can always catch up again. And please note that we're also rerunning the live webinar tomorrow evening, Tuesday evening from 5:30 p.m. So 5:30 to roughly 7:30 or 8, we'll just see how it goes. We'll have a rerun, so if you want to join a live session, you can also do that tomorrow if you just book on that for that session. Okay, so I think now moving on to the speakers. I am a director at BDO. In fact, all of the speakers this morning are directors at BDO. I'm head of tax technical, and as I said, my name is David Warnicker. I've been very involved with the COVID-19 bill process in my capacity as chair of SAICA's National Tax Committee. So we've submitted various comments, both from the perspective of BDO, and also SAICA has also submitted their own comments on various issues relating to the reliefs. And it's pleasing to note that our comments have been, by and large, a lot of them have been acceded to. The first drafts have been amended to take those into account. We've got, and this is more or less in order in which the speakers will present today. We've got Danae Howell. So with regard to Danae, she heads up our individual compliance, estates and trusts division and has almost 20 years of experience in this area in tax, a very well experienced director. We've got Steve Kerr, and Steve has extensive experience in corporate tax, both in South Africa as well as in the UK, where he worked for a number of years. Chris Smith has extensive experience in corporate tax as well as international tax, And in addition to that, he's an external examiner on UCT's Masters in Tax program. Hilton Cameron. Hilton is mainly involved in international tax, but also works to a large extent in corporate tax as well in South Africa. And he's also lectured on the Masters in Tax course at Wits University. Bruce Russell. Bruce is mainly involved in domestic corporate tax, but also in pay-as-you-earn and VAT. Seelan Muthayan. Seelan heads up the indirect tax division at BDO, and he's previously worked at SARS, as well as in commerce and industry, amongst other appointments that he's had. Marcus Stello. Marcus is our transfer pricing expert, and he's previously worked at SARS as well as in Australia. Cliff Watson. Cliff specializes in indirect tax, and he also advises on VAT and customs, and he's also previously worked at SARS. I'm not sure if Cliff is going to present today. We might not have Cliff on, as well as Marcus might also not be on. Marcus Buerta, who's the head of corporate tax, and he has previously led PwC's tax reporting and strategy division within South Africa. So if you've got questions, as I say, please type them in the Q&A. Use the Q&A functionality for those, and we'll take them at the end. Also, the email addresses of the individual speakers will be on one of the slides. So if you want to contact them, any of us personally, then you can please feel free to do so. There'll also be an email address specifically provided for questions. If you want to use that general functionality, you can also do that. Okay, so moving on to now to have a look at the specific reliefs that have been provided in the COVID-19 bill. Sorry, before I get to that, let's just run through very quickly a list of the issues that we are going to cover today. So these are itemized on a slide, and this is more or less in the order in which we're going to cover them today. Ashley, if you could just move it on. So we're going to look at these various issues, and as I say, this is more or less in order. I'm not going to run through the list now. It's up there on the screen. We're going to start with the COVID-19 tax relief summary. So if we could move on to that. So what we're talking about here are the specific reliefs, as I say, that have been provided in these two bills that have been released for public comment, and they're open for public comment now until the 15th of this month. There was a previous life of these bills. There were public comments that were received. As I say, quite a number of our comments were acceded to, and these bills have now been re-released. They by no means are, we think, perfect, and we've made some other recommendations, and hopefully those will be taken into account, or some of those, in the final version of this bill. So just starting off with the deferral of pay-as-you-earn and the deferral of provisional tax payments of 35% essentially for both of these reliefs. What's important, and I think a bit unfortunate to note about these, is that these standard reliefs only apply to small and medium businesses. So if you have a look at the bottom of that slide where it says qualifying SMEs, those are tax compliant companies, trusts, partnerships, or individuals. And what's meant by small and medium in this context is that the gross income has got to be less than 100 million of those individual companies, trusts, partnerships, and individuals, determined at individual company level, not at group level. And in addition, less than 20% of that gross income must be derived from passive income and remuneration. So there's a maximum 20% given for passive income and remuneration. Passive income in this last version of the bill includes rental income. But note that rental income won't disqualify a taxpayer if it goes more than the 20% of total, if substantially the whole of the gross income, as well as the primary trading activity, is fixed property rental. So substantially the whole, one understands that percentage. Generally, SARS interprets that to be 85% or more. So if 85% or more of the whole of the gross income is from fixed property, that rental income won't disqualify the taxpayer. The gross income is determined in 1 year of assessment only, and that's the year that ends in the period from 1 April 2020 up to 31 March of next year. So in other words, the gross income is determined in the year of assessment of the taxpayer that might still be ending. So you might be in a position where you're not actually sure if your gross income is going to exceed that threshold or not. So I think if you are relying on that and you believe that the gross income is going to be less than 100 million, but it turns out, in case it turns out to be more than 100 million, which I suppose maybe in these challenging times is, maybe a bit unlikely that it would exceed the expectations, but there are some businesses that are doing well in these times. And what I suggest that you do is certainly document at the time you're relying on your relief exactly why you believed that it was going to be less than 100 million. But also note that on SARS's website, even if the business is more than 100 million, you can still qualify on a case, you can still apply directly to SARS on their website on a case-by-case basis for deferral of tax payments in general. So this applies to businesses with more than 100 million, or in fact, if you fall within the SMEs, but you, as defined here, but in addition to those specific reliefs, you need to claim other deferrals, etc., you can still apply on a case-by-case basis, and SARS will consider it. And so if you go to SARS's website, email addresses have been made available specifically for these COVID-19 additional reliefs. But now, just getting back to this deferral, we've got a deferral of 35% of pay as you earn by the SMEs, the first bullet on the slide. It's for a 4-month period only, 1st of April up to 31st of July, and it applies to pay as you earn that is in respect of remuneration paid to employees during those 4 months from 1 April to 31st of July. And so you end up paying 65% only for now. The 35% that's deferred for those 4 months is totaled up, and that is spread in 6 equal installments, and you've got to pay that with the payment that's due for August. So in other words, that's payable by the 7th of September, from September through to February, 6 equal installments, plus the pay-as-you-earn applicable to those specific months will then be payable. So it's simply a deferral. It's certainly not, it's not a holiday as such. It's just a deferral. And as I say, you've got to make it up in 6 equal monthly installments from the 7th of September through to the end of February. The 2021 provisional tax payments are a similar idea in that the percentage is essentially 35%, and that's also a deferral, although you get a longer period to pay that back in. So with respect to the first payment, you can defer 15% of your total estimated tax liability. So instead of paying, as you normally do, 50% of your estimated tax liability with your first payment, you now pay 35%. Sorry, you pay 15%. So you're deferring 35% of that first provisional payment. And in respect of a second payment, you then have to have paid by your second payment date accumulated 65% of the estimated total tax liability. So once again, you can defer 35% accumulated. And that 35% has then got to be paid by your third topping up payment in order for interest not to apply. As I mentioned, what's important for both of those reliefs is that a taxpayer must be tax compliant. In other words, they must be able to get a tax compliance certificate at the time that they seek to rely on those reliefs. So I really strongly suggest that you take a screenshot or you print out a tax compliance certificate to show, in case there's a quibble with SARS later, that you were tax compliant when you sought to rely on those reliefs. Ashley, if you could move on to the next slide for us. Then we get monthly ETI credits, employment tax incentive credits, an additional 750 Rand per qualifying employee per month for the 4-month period from April to 31 July has been made available. It's not an automatic 750 per employee. Please note, it's a sliding scale. The sliding scale there's a formula in the bill, but it goes down steadily. The more you pay a person above 4,500 Rand a month, up to the maximum of 6,500. So this additional 750 scales down. So what one can claim then is, instead of 1,000 Rand in year 1, you could claim up to 1,750 if the employee is under the age of 30 years. In year 2, where it's a reduced benefit, instead of 500 Rand, you could claim up to 1,250 Rand per month for those 4 months. And the important thing to note here is that it's not only the regular employees that you could qualify for that give you the relief. It's been extended for people that are not young anymore. You can still claim 750 or up to 750 for those if they're above the age of 30 but not more than 65. So one can claim up to 750 Rand for them as well. As well as if the youth, if they are young but they're not eligible because you're more than the 24 months within which one could normally claim the ETI benefits, there one could also claim up to 750. The important thing here is that the employee must not earn more than 6,500 per month for this ETI benefit. If it's more than 6,500, you get nothing as an additional claim. Another benefit that's been provided is, instead of paying out reimbursements by SARS, those reimbursements have been accelerated to monthly for this 4-month period, whereas before you'd only get them twice annually. And what's important for these reliefs is that the employer must have been registered with SARS as an employer on the 1st of March of this year, and must also be tax compliant, in other words, be able to qualify for a tax compliance certificate at the time when one seeks to claim the relief. So that's the ETI credit. Then there's a fast tracking of VAT refunds, and this applies to the category A and B vendors. So those would be vendors who on a 2-monthly VAT cycle, and they can voluntarily file monthly for these 4-month periods. For this 4-month period, so this goes essentially up to the end of August, depending on whenever your VAT period ends, that you could actually, if you were in a net refund position from SARS, you could accelerate that refund by filing monthly and not having to wait for the 2nd month for that cycle to apply. As I say, it's completely voluntary. And then, as I mentioned earlier, what's important, and we were hoping that government would extend the reliefs of, extension of payment for tax due to other businesses. They have done that, but unfortunately it's on a case-by-case basis for bigger businesses. It's not on a, sort of standard basis that one could apply. So as I mentioned, direct application may be made to SARS by larger businesses, in other words, more than 100 million of gross income, for instalment payment arrangements without incurring penalties, or by qualifying SMEs for additional relief over and above what we've mentioned already, the 35% and so forth. If you look at the SARS website, it says, what's interesting, application may be made even if the taxpayer has a history of non-compliance that would otherwise make them ineligible for relief. Of course, SARS is going to, one imagines, is a very careful look at the history of non-compliance, if there is one, before acceding to additional relief. And what it does say, though, is that the taxpayer must have serious financial hardship which can be demonstrated and which must be attributable to the effects of COVID-19. The taxpayer will have to prove that the installment payment arrangement is required because of the impact of COVID-19. Ashley, if you could move, please, to the next slide. So also to note, there's a 4-month payment holiday from skills development levies for employers generally. So all employers, regardless of size, won't have to pay a skills development levy, which is essentially 1% of their payroll, more or less, from the 1st of May to the 31st of August. So in respect of those months' payrolls, remuneration that's earned during those 4 months, the employer won't then have to pay skills development levy. And then there's also been an additional amount that's been allowed for Section 18A deductions for donations to the COVID-19 Solidarity Fund. And Danae is going to deal with that issue separately in her presentation. So without any further ado, sorry, there's a few other issues. Sorry, if you could just go back. Before I hand over to Danae, just to deal with carbon tax. The filing and first payment of carbon tax has been extended by 3 months from the 31st of July, which was the date by when businesses would have to have filed and made their first payment. As I say, they only have to now pay that by the 31st of October. And then excise taxes on alcoholic and tobacco products, which are payable at source, and that's what's created the problem, because although sales can't take place, there's still, those businesses that are involved in that industry have still, in theory, would have to make payment of excise taxes. That has been extended by 90 days for excise compliant businesses as well. So those taxes only got to be paid 90 days later than they would otherwise have had to be paid. And then the income tax base broadening measures, I'll speak to that a little bit later in the presentation. Those that were announced in the 2020 budget relating to assessed losses and also limitation on interest deductions, those have been put off by at least 1 year, so that they would only now kick in at the earliest 1 January 2022. Right, Danae, over to you.
Thank you, David.
Thank you, David.
Ladies and gentlemen, good morning.
Good morning.
Ashley, thank you. The next slide. There we go. The employment contract entered into between an employee and an employer is the basis of an employment relationship. It governs the terms under which the employee will render services to the employer, as well as the terms under which the employer will remunerate the employee for services rendered. With the national lockdown, employers are faced with the question whether an obligation actually exists in law to pay employees in circumstances where the employees have not rendered services during this lockdown period. Well, basically, in terms of the Basic Conditions of Employment Act, a wage is defined to include any amount of money paid or payable to an employee in respect of ordinary hours of work. Therefore, an employee is under no legal obligation to pay salaries to employees we know hours of work, and that's really inverted commas, hours of work have occurred, even through no fault of the employee, that he or she may not have met their contractual obligation. Therefore, if there's no service rendered, there's no entitlement to a salary, and therefore there would be no accrual for income tax purposes, resulting in no liability on the employer to withhold employees' tax. But if an employee is able to render the service, whether remotely, working from home, or being fortunate enough to go back to the office, the employer is then obliged to pay the employee, and therefore there will be an accrual of salary, which would then lead to an obligation to withhold employees' tax from the salary paid. It's important to understand whether there's this entitlement which arises to a salary or not, because especially in these times, as the employer and the employee could be faced with various scenarios, including where the employee forfeits a portion of his or her salary for the benefit of the COVID-19 relief funds. Or, unfortunately, reality will probably be realized shortly for many employers that face financial hardship, where an employee will have to agree to a reduced salary. If proper procedure isn't followed, an employee could find him or herself in the position where, for tax purposes, the full salary is deemed to have accrued to such an employee, which will result in the employee's tax being calculated on the full salary, while in reality, the employee only receives a portion of the salary. So just please bear that in mind. Then just to the decision whether an employee wants to donate a portion of their salary to charity. But I think before we discuss that, let me just recap briefly the relief measures that are available or applicable to donations. Essentially, a special dispensation has been proposed by Treasury, and as David has mentioned, it's in its second cycle of draft bills that will apply to funds established specifically for purposes of COVID-19 disaster relief efforts. These funds will receive the same tax treatment as qualifying public benefit organizations. Essentially, the tax exemptions will apply for a 4-month period beginning 1st of April 2020 and ending 31st of July 2020. The exemptions which will apply is all receipts and accruals to such public or COVID-19 relief funds will be exempt from income tax. Donations made by or to such funds will be exempt from donations tax. Donations made to such funds will also qualify for a tax deduction in the hands of the donor, which is subject to the limitations provided within our Act. It's known as under Section 18, capital A, which is currently at 10%. But legislation has been proposed to say that if donations are made specifically to the Solidarity Fund, this 10% increase or donations, taxable donations percentage will be increased to 20%, whether the donation is made in cash or whether it's in kind. Therefore, I think any donation in excess of the 20% to the Solidarity Fund and 10% to any other fund will be able to be carried forward and deemed to be a donation made in the succeeding year. So there's a bit of a rollover relief. If everything isn't being able to claim in 1 year, it gets carried forward and up to a 10% limit in the succeeding year. Okay, but and that's available to both individuals and companies. Okay, But in respect to an individual taxpayer, you'll recall our president's challenge to many CEOs and executives of companies, as well as to government itself, to donate 1/3 of their salaries to the Solidarity Fund. The question of entitlement that I just discussed requires that the amount so donated or forfeited must first accrue to the employee. Therefore, the amount is subject to income tax. However, the relief measures proposed now at least allows for a deduction in the hands of the employee in calculating pay-as-you-earn. So in order to help an employed individual from a cash flow perspective to make these donations to the Solidarity Fund, the current 5% payroll giving provision that's found in the fourth schedule to the Act has been or is proposed to be increased to 33.33% for 3 months or 16.66% for 6 months, depending on the employee's circumstances. In both scenarios, that calculates to 100%. This payroll giving provision essentially allows an employer to take account of such donations in the calculation of an employee's monthly pay-as-you-earn. And there is the benefit in the cash flow. So an employee does not need to wait until year end when I file my tax return to be able to claim the tax deduction for donations made. You actually receive a monthly cash flow benefit on any sort of donation made to the COVID-19 relief funds. However, on final assessment, when you submit your tax return, the limit of 10% to normal COVID-19 relief funds and up to 20% to the Solidarity Fund will be calculated. Thank you, Ashley. The next slide, please. Thank you. So, unfortunately, onto the potential inevitable for a lot of companies. Should an employer not be able to continue with its operations, notwithstanding the financial and tax relief measures in play, it's obliged to follow labour law procedures with regard to termination and retrenchment of its staff. From a tax perspective, any lump sum received by an employee because of his or her termination or retrenchment will qualify as a severance benefit. A severance benefit for tax purposes falls under a more beneficial tax dispensation than normal income. It essentially allows the first 500,000 of the lump sum to be tax exempt. And there's a sliding scale that's applied to the balance of the lump sum, with the maximum marginal tax rate of 36% only introduced over R1 million, R1,050,000. This is compared to normal tax rates of 45% at 1.5 million tax threshold. But please do note that this severance benefit dispensation doesn't qualify with the employee in question at any time held more than 5% of the issued share capital or members' interest of the company, unless he is older than the age of 55 years. Also, please do bear in mind that notice pay and leave pay, which are payments essentially for or are payments in respect of services rendered, must be excluded from a severance benefit. So once an employer has calculated the lump sum payable for severance benefit, the employer then needs to apply to SARS for a tax directive, which then will instruct the amount of employees' tax to be deducted. Okay. Next slide, please, Ashley. Then just on to provisional tax estimates for companies, but please, this would also similarly apply to individuals and trusts. So notwithstanding the relief measures proposed to defer the payment of the provisional tax liabilities, which David mentioned under his introduction, one must be mindful that punitive measures remain enforceable for the non-compliance of the relevant tax laws, whether by a qualifying SME or other taxpayers. Namely, there's a 10% penalty on any late payment of provisional tax, and there's a 20% penalty on the underestimation of taxable income. So it's imperative that the qualifying SME still applies the relevant tax law in its calculation of the provisional tax estimates, whether in respect of the first or second estimates, and just to be mindful not to fall foul of that law. So essentially your first payment, which is required 6 months after the commencement of your year of assessment, the taxpayer must make the estimate of its taxable income for the year of assessment. And SARS generally allows that one can rely on a term called a basic amount. A basic amount is essentially the taxable income as assessed for the preceding year of assessment. Now, a taxpayer is generally required to justify to SARS, if called upon, where their estimate is below the basic amount. But SARS can at any time where it's not satisfied that the basic satisfied with the basis of the estimate, whether it's the basic amount or not, increase such estimate made by the taxpayer. It does, however, allow a person an opportunity to comment and discuss the basis of the increased estimate. But once SARS has made a decision, that decision is not subject to objection and appeal. SARS also does allow a revised payment period before it imposes any sort of penalties on the late payment or interest. So if payment is not made in the normal course, or payment is not received by SARS in the normal course of provisional estimates or as part of this increase, then a 10% penalty on the amount payable is imposed. Interest is charged on such amount outstanding. With regards to the second payment generally, together with the estimate, coincides with the taxpayer's year end and carries a risk of penalties for underestimation of the taxable income. So where the taxable income is less than R1 million, the penalty on underestimation is calculated on as 20% of the tax calculated on the lesser of the basic amount, or 90% of the actual taxable income, less any provisional tax actually paid. While if your taxable income exceeds R1 million, the penalty is 20% of the tax calculated at a rate of 80% of the actual taxable income, less any provisional tax actually paid. In an individual's case, bear in mind, we are able to deduct the employee's tax, any pay as you earn, also withheld. SARS is able to remit any penalties imposed if it's satisfied that the estimate was seriously calculated and wasn't deliberately or negligently understated. And I think with the COVID-19 realities, I think SARS would be more readily accepting of these sort of mitigating circumstances. Also, please just note that the voluntary third payment can be made within 6 months from year end, that's for companies, while in 7 months for individuals and trusts. Since this payment is voluntary, there's no imposition of penalties if payment is late, but interest is levied on any type of late payment. Thank you. My colleague Steve Kerr will now discuss the next topic.
Thanks, Danae. Thanks very much. So I'm just going to have a few words about rental holidays. This was probably one of the first things that came up when COVID arrived, where mainly in the retail sector, there were quite a few retail tenants who were looking for relief from their landlords. The South African Property Owners Association in early April put together with the REIT Association their proposed reliefs for retailers, and they were generally deferral reliefs, which depended on the type of business that the tenant carried on. But they were subject to the caveat that this really depended on agreement being reached between the landlord and the tenant. So they were, I think, put forward as minimum proposed reliefs as a property association proposal. But essentially, why have we put it here for tax? It's the same reason that Danae was referring to in the salary context, this distinction between the legal position and the payment position. And that because these are largely deferral reliefs, one needs to make sure that the tax position, being the VAT and the income tax, will follow the legal position. So one of the points they made in this document, the Property Owners Association said that really the tenant and the landlord need to agree formally as to what the deferral relief is, and is it just a deferment of the payment of rentals? Is it possibly a holiday? Because the tax will follow the legal position. So from a VAT perspective, the VAT timing rules follow when the rental is due or is received, and that applies both to the landlord and the tenant. So a typical deferral relief would push the VAT event out, provided it's properly documented. From an income tax perspective, the landlord's position looks to receipt or accrual, and that's unconditional entitlement. And whilst from a tenant's perspective, the income tax rule of expense looks to unconditional obligation. So again, one needs to look back to the agreement between the landlord and the tenant to make sure that the tax follows the economic result that both parties are after, so we don't end up with a mismatch. For example, if there's a year end that this relief straddles, you could end up with a mismatch. So that's the purpose of the rental holidays, and us including this slide. It was really just to draw everybody's attention to this distinction between the legal and the economic position. If we could have the next slide, please. So inventory valuation here, as everybody will be aware, there's an income tax relief or valuation position in the Income Tax Act that says that that's inventory is valued at cost, less an amount for deterioration in value due to damages, fashion, decrease in market value. And again, the reason why we've put this in here is that I think we're going to probably see these net realizable value tests having to be revisited because you could have imported stock, say dollar stock, that would be in rand terms maybe has actually gone up in value, but may also have gone down in value because of the bad economic position. So I think the warning here is just really, when one comes to a year end, have a look at those net realizable value tests because they may have actually moved. The next slide, please. Business rescue and liquidation. I think the important point here is that when companies or groups of companies get into distress, they as we've seen, business rescue practitioners are appointed, or possibly the company goes into liquidation. The important point here is that the process of business rescue or liquidation doesn't interrupt or change the tax position of the company. All that happens is that the business rescue practitioner or the liquidator steps into the shoes of the directors and takes over the responsibilities as representative taxpayer. And that's the important point, is that continuity carries on. This position is important because the public public officer needs to attend to the tax affairs of the company and is responsible for the tax affairs. In terms of the company's tax position, the important thing to watch, and this will be covered in a later slide, is to whether the company is trading or not. And that's going to affect things like the balance of assessed losses, whether they survive or not, and maybe even deductibility of expenses, which again we'll look at later on in the presentation. So really the message here is business rescue and liquidation. It's business as usual within the company in terms of tax compliance, other than we have the business rescue practitioner and the liquidator taking over, and then just watch the trading within the company. That's the lot. I'll hand over to Chris Smith, who's going to take you through the next slide. Thank you.
Thanks, Steve. Good morning to everyone. We're going to look at debt financing relief, and the critical element of debt financing relief is how do we save cash flow in the company? How do we preserve that cash flow? And is there anything that we can do that recapitalizes the company internally so that it can go to banks and borrow additional funding or obtain additional financing? The reliefs that preserve the cash flow have taken on the form of lower interest rates, and this is not just from the Reserve Bank and from banking institutions, but this could be negotiated between corporate entities and the banks. Also, what we've seen is interest deferrals and not too many waivers of interest, except in certain distressed markets. The last leg looks at the capitalization of interest to loan and capitalization of shares, which is really aimed at building up the balance sheet so the company is able to access bank funding. Just some additional tax consequences to be considered that have been announced as part of COVID is we have a rule under the base erosion limitation where interest was limited by a formula to a percentage of EBITDA. That percentage was subsequently reduced to a factor of 30% of EBITDA in the current budget announcements. Under the COVID rules, these have all been postponed until 2022. So there is some relief in terms of that. In relation to interest withholding tax, Hilton will deal with that. Can I have the next page, please? So the debt relief that we're looking at and the effects of this between the lender and the borrower. The first two relate to either an interest rate reduction or alternatively to a deferral. Both will result in a new Section 24J calculation and the interest being spread over a further period. So what will happen is the lenders will receive reduced income, the borrowers will have reduced cash outflow, and that's critical to preserving cash flow. In limited instances, we have seen interest waivers for industries where there has been very difficult circumstances. Again, that is going to lead for the borrower potentially to recoupments and a recomputation of the 24J interest calculation. In relation to a capital waiver, remember that for a capital waiver, particularly for the borrower, what we would see is a reduction in the base cost of the asset that they acquired with that funding. Again, that cash flow, any payments of cash flow effectively are deferred until ultimate realization of that asset. Similarly for a recoupment if the loan funding was used to acquire trading stock. There is, however, limited group relief for groups that qualify in terms of Section 41, that's the restricted group definition. Under certain circumstances, you can avoid the implications of having these recoupments. Additionally, what we have seen is instead of obtaining cash flow payments, that the outstanding interest has been capitalized to the loans. Again, what happens then is we have a recomputation of the interest calculation going forward. And the one that we find quite interesting and has been spoken about by many corporates, and particularly to us, is capital and interest is capitalized in return for the issue of shares. So this often happens within a group, but in these particular circumstances, yes, there would be a recoupment of interest capitalized, but not if it happened within a group. There'd also be no recoupment of a capital because there's very specific reliefs that allow this to happen. Again, the benefit of this is that the corporate can now go to the bank and obtain additional funding. Could I please have the next slide? Thanks. With the prices of shares going down, and we're seeing a lot of share schemes underwater, this particular slide really relates to if corporates have paid out or have issued share options or issued shares for payments, whether they be restricted and there's still periods to go on these shares, they can return whatever the employee has paid back to them, back to that employer without any payroll or tax effects. But it is very critical that the refund that goes to the employee must be exactly the same as the consideration that the employee gave for those shares or those options. Obviously, going forward, everyone will take a look and decide whether it's an opportune time to exercise options, and that depends on your view of how long this crisis lasts and the effects of the share prices going forward. Thank you very much. Can we have the next slide? And I'd like to introduce Hilton Cameron, who's our Head of International Tax. Thank you.
Thank you, Chris. So I'd like to talk about the foreign exchange movements. So generally, Section 24I deals with foreign exchange movements. It's one of the more complicated sections of the Income Tax Act. Fortunately, accounting and tax follow each other most of the time, so generally it's not a non-issue. However, an important issue at the moment is that where you have unrealized gains and losses with connected persons, those unrealized gains or losses will be deferred if certain criteria are met. The main criteria is obviously the loan is with a connected person, and the other important one is that the loan is a long-term asset or liability and is not hedged by an FEC. So the important issue at the moment is often you can imagine you own your foreign parent an amount in dollars or in euros, pounds, and you've now taken a massive loss for accounting because you owe them a whole lot more. For tax, if those various criteria which I've just mentioned were met, you won't be able to take that loss for tax purposes. A possible remedy for the above is changing the loan term, so it's no longer a long-term asset or liability, or taking out a hedging instrument. One must just be careful if you're just doing this for tax reasons, there could be an issue with doing that. Next slide, please. The next issue I want to go on to is deferred royalty and interest payments, and after that I'll be hitting dividends. But let's just start off in the deferred royalty and interest payments. So at the moment, obviously, this global pandemic, the holding company is trying to assist its subsidiary, and they'll often say, okay, we're going to waive the interest, or we're going to delay the interest, we're going to delay the royalty. But an important part for royalties and interest is withholding tax is levied on when the amount is paid or when the amount is due and payable. So even though the amount may have been waived or delayed, you need to look at what is the exact term of the agreement between yourself and normally your group or offshore group entity to see if you have also delayed the withholding tax, because you may have delayed the actual payment, but you may have not stopped the withholding tax to be levied. One thing which I can mention, which is not specifically regarding the pandemic, is the issue of the withholding tax declaration. And I see this issue time and time again, is where we have a treaty with a foreign country, a double taxation agreement, and this applies to most of our major trading partners, the rates on interest and royalties are often significantly reduced and even sometimes nil. However, to get the benefit of such rates or reduced rates, one needs to complete the withholding tax declaration. This is a simple 2-page form, but it must be done before the amount is paid or before it is due and payable. It's simple to do, but I've seen time and time again parties do not complete it. Next page, please. Similar to the royalties and interest, as I said, the dividends follow a similar basis, that the dividend withholding tax is also due when the amount becomes due and payable. Fortunately, in this scenario, you've got more control in this fact pattern, because you are the one declaring the dividend. So you need to make sure that if your dividend is delayed, that the withholding tax is also going to be delayed. So one of the particular issues at the moment is where you have professional firms which are incorporated and dividends are used to pay salaries. So if the shareholders have decided to take a cut in order to assist the business, they should ensure this is also going to delay the withholding tax, as the withholding tax may still be due if the dividends tax forms are not completed correctly. Once again, like the dividends, the interest and royalties, again, if there is a dividend being paid offshore, the dividend declaration form must also be completed. Next slide, please. In terms of capital gains tax, the main issue on capital gains tax, which will trigger the CGT, is when the suspensive condition in terms of the sale is met. So this can give a rise, especially at the moment, where your suspensive condition can have been met, but payment is not yet due. So once the suspensive condition has been met, there has been a CGT event and capital gains tax will be payable. It may not be payable yet, but it'll probably be payable up to year end or at year end. But the important issue to realize is the suspensive condition, once that is met, that is when the sale has occurred, and therefore the CGT will be payable. In these times, one of the big issues at the moment is fixed property transactions, which have probably decreased, but often the deeds office registration may not, while it may delay the official transfer of the property for tax, it may not delay the timing of the payment. So one should specifically be careful with immovable property. The final issue, which I'll mention for the time being, is for valuations. I'm not sure if everyone is aware, but when property is disposed of between connected persons, then the property is deemed to be disposed of at market value. So one often can use group rules to alleviate such issues, but obviously at the moment property has decreased in value. And if you can now transfer property between one entity and the other, you may not even have to look at your group rules to obtain relief. Just simply look at the current market value, and you should be able to, you may be able to avoid any CGT issues. The final issue in terms of valuations is, I don't know if people are aware, but when you immigrate, the day before you immigrate, you are deemed to dispose of all your assets. So again, due to the depressed value of all of assets at the moment, especially various shares, now could be a good time to look. I'm not sure if you can actually leave though. I think that's next slide, please.
Good morning, everyone. It's Bruce Russell speaking. I think that it's probably fairly evident or expected that given the financial crisis that might arise due to the COVID disruptions, that inevitably there will be an increase in bad debt write-offs and provisions for bad debts. Just to really recap what type of income tax and VAT reliefs may be available for these bad debts and doubtful debts. Firstly, from an income tax perspective, Section 11I of the Income Tax Act grants a 100% bad debt. The question is what requirements have to be met before this bad debt can be claimed? Well, firstly, the debt that you're seeking to deduct has to have previously been included in income. So this would typically apply where goods or services have been supplied on credit, with credit terms. Importantly, also note that it's the amount that the bad debt that would be allowed is only in respect of the income that was previously included in income. So that would typically exclude the VAT portion of a debt which is unpaid. There is a VAT relief in terms of Section 22 of the VAT Act for irrecoverable debts. Irrecoverable debts, unfortunately, is not defined in the VAT Act, but prior SARS practice would typically regard a debt as irrecoverable if the vendor has actually processed the bad debt in its accounting records and has either ceased to actively recover the debt or has handed the debt over to attorney or debt collector. to try and attempt the recovery of that debt. You know, in the past, really bad debts from an income tax and VAT perspective were relatively similar, in that the debt, or recovery for the debt has ceased. SARS, in a recent draft interpretation note, have passed the comment that from an income tax perspective, even though the debt or the chances or probability of recovery of the debt is low, if the creditor is still seeking to collect the debt through a collection process, they, in their view, would not regard that as a bad debt from an income tax perspective. So it's quite a narrow interpretation, which we hope they will address or be a bit more amenable to changing when they issue their final interpretation note on doubtful debts. From a doubtful debts perspective, there's the Act was amended with effect from 1 January 2019. Before that, it was the usual doubtful debt, or 25% of the accounting doubtful debts provision that could be permitted. For years on or after 1 January 2019, it's important to look at whether IFRS 9 has been applied or not. Before looking at the doubtful debt allowance provided for IFRS 9 companies, I think it's useful just to take a look at what IFRS 9 looks to, so the stage of impairments. So the first stage IFRS 9 looks at is your type of debts where there's no change in the, or there's no significant change in the expected credit losses. There's no type of events that would indicate that there's been a significant change as to whether debtors would pay or not. Those debtors impaired, so your stage 1 debtors impaired, will typically only be allowed a 25% allowance in terms of the new provisions. Where debtors are reflected as doubtful in terms of stage 2 or stage 3, so there has been a significant change in credit risk, there would be a 40% allowance granted. Now, importantly, these allowances in terms of IFRS 9 do not extend to debt or persons who are granting credit in terms of lease arrangements. So where, for instance, there's a lease of an asset involved. The reason for that Treasury gave was that because those lessors would typically be allowed a wear and tear allowance, and hence it wasn't necessary to extend tax relief to doubtful debts for them. For those taxpayers that are not applying IFRS 9, debt which is overdue by 120 days or more is granted a 40% allowance. Debt that's between 60 and 120 days is granted a 25% allowance. Debt that is overdue below 60 days will not be entitled to a doubtful debt allowance. So it's important for those taxpayers that are paying or applying or not applying IFRS 9 to understand when are the terms for each debtor. Because only once those payment terms are exceeded, does the debt become overdue and the days start counting. SARS does, or at least the legislation does, allow for an increase in these doubtful debt provisions, so beyond 40%, for instance. The maximum legislated is 85%. The application process that you have to go through is rather new, and SARS have issued a interpretation note and draft, it's called a request for information and risk models. The documentation that's been given to date is more prescribes what steps need to be taken. Unfortunately, it hasn't really spoken too much about how SARS are going to apply the criteria in the Act in granting an additional up to 85% allowance. Also, unfortunately, SARS haven't in their draft interpretation note addressed how to treat these allowances when it comes to taxpayers that are applying the simplified method of impairment in terms of IFRS 9. Given that the simplified method applies to debts which are typically payable within 12 months, and hence the lifetime expected credit loss would be more or less the expected credit loss, we would anticipate or hope that SARS would agree to a 40% allowance on doubtful debts determined under the simplified method. We hope to address this in the draft or comments in the draft interpretation notes, and hopefully there's a bit more clarity once that draft interpretation note is finalized. If we go to the next slide, which deals with insurance claims, certainly in these challenging financial times, there may be additional insurance claims in respect of loss of profits. These insurance payouts will typically be taxable as they are intended to fill a hole in a taxpayer's profits. So case law would, or precedent in terms of case law would be that these amounts would be taxable. As to the VAT treatment, I'm just going to ask Seelan to give a little bit of commentary regarding the VAT treatment of insurance payouts.
Yes, thank you, Bruce. Usually when insurance payments are received, they include a component of output tax. It has come to my attention on a number of occasions where VAT vendors are not accounting for the output tax. If you're uncertain as to whether you need to account for output tax or not, or where there is an element of output tax included in the indemnity payment, I'd recommend that you contact your insurer and just make sure that it is accounted for in your tax return when filed. I'll now hand you over to Marcus Steller, our head of transfer pricing.
Thanks, Seelan, and good morning, everyone. My name is Marcus, and I have the pleasure of taking you through the transfer pricing side of things. Unlike the rest of this webinar, there have been no changes to our transfer pricing legislation, nor have there been any reliefs announced, which means we will still have to comply with the arm's length principle. It is not all doom and gloom, though, as we have some options available on how to support the arm's length principle in economic circumstances such as this one. To take you through these options, let's consider current business models, transfer pricing methods, and related benchmarking. Many business models consist of a single entrepreneur with low-risk operating companies throughout the world, or the business model would at least have some low-risk operating company. These can include limited risk distributors, total or limited risk manufacturers, or service providers. From a transfer pricing perspective, these operating companies usually have routine functions and are considered the least complex party in the value chain, and therefore are tested from an arm's length perspective. These routine functions are expected to earn a small but stable profit margin on a net basis, and allocating losses or breaking even is highly unusual, but nothing is normal right now. From a transfer pricing perspective, low risk still carries some risk, unless it is a risk-free arrangement, which is seldom the case. So there are some things multinationals can do to try and share the burden with these low-risk entities. Firstly, benchmarking studies usually consider previous 3 years to compare to the current year. This is unlikely going to result in an accurate benchmarking due to the current economic circumstances, and the comparable range may be much higher than compared to the same companies during the same economic environment. Therefore, we should consider some of the following. Adjust our results to the lower quartile, if not already done so. Use different time periods where relevant, maybe even compare this to the 08-09 financial crisis, or performing working capital adjustments to take into account things like increasing accounts receivable balances during this crisis. Secondly, for some operations, we may need to consider if the current costs associated with the operations are still value adding or should be reconsidered as they are extraordinary, and this may then reduce the required fee to be charged. The next point on the slide, in relation to government assistance, should also be considered in relation to the above, and as per the OECD guidelines. There are some circumstances in which a taxpayer could consider that an arm's length price should be adjusted to account for government interventions, such as quarantines and travel bans. To bring this all together, this should then form part of relevant transfer pricing documentation. Here we have a few options. For example, there's merit in having a COVID-19 chapter in FY 2020 documentation that talks to this and aligns the industry analysis and government interventions. This chapter could also look at some sort of budgets which should be tested to prior years versus actuals and explain the difference where this assists our analysis. Ultimately, it should be made clear that there was no mispricing that resulted in the losses, but rather it was the economy, and therefore this could still be supported by the arm's length principle. From my experience, documenting something like this shortly after the occurrence is best in order to avoid any confusion as to what happened a few months or a year ago. Lastly, a multinational can also reconsider financing structures to elevate cash flow issues. As a result of the pandemic, multinationals may be in more need of funds for the stability of the business. The drastic changes in the market could trigger clauses in financing arrangements for collateral or the maximum level of debt to equity of the borrower. Under the new guidance from the OECD on financial transactions, it may be reasonable to renegotiate financial arrangements to more favorable terms, as discussed by Chris earlier, as this is similar to what third parties are doing right now as well. As you can see, there are some options, and even though we have not received guidance from the OECD around this, it seems the OECD is trying to provide further guidance or insights on how to deal with COVID-19 by the end of the year. I hope you found this insightful, and please let me know if you have any questions at the end of the webinar. David, back to you.
Thanks very much, Marcus. So I'm going to just to come back to a theme that I spoke about a little bit earlier on when I did my other presentation. One of the proposals in the 2020 budget speech this year was that we'd be going away from the time-honoured principle where if a company has built up an assessed loss, that it would be able to carry that loss forward without any restriction, well, for an unlimited period of time, provided that it continues to trade every year. And the proposal that was mentioned in the budget speech was that going forward, that companies would be exposed to tax on 20% of their taxable income in the year, and that up to 80% of it then could be used to set off against an assessed loss carried forward. In other words, you pay tax on a minimum of sort of 20% of the taxable income without being able to shield that against an assessed loss. Now, what's likely to happen, of course, with the COVID-19 era and the recession that we're in at the moment, that companies are probably going to start incurring losses, and so one expects these assessed losses to be quite considerable going forward as a result of this. And fortunately, one of the measures that's been announced is that this proposal, whereby you'd be exposed to 20% of your income going forward, that has been put off by at least a year. So companies will have an additional year to use these losses that have been brought, that they're bringing forward, not only as a result of COVID-19 losses, but other losses that they may have built up in past years. And so that is a very, very welcome measure that is being proposed in these bills. I might just also mention another proposal that was mentioned in the budget speech this year, whereby companies would only be able to claim interest deductions up to 30% of their net interest expense, and that has also been put off by at least a year. So the earliest that will apply is 1 January 2022, and it may even be later. So two very welcome measures that have been announced as part of this process. Okay, I think now I give over to Hilton and Seelan.
Thanks, David. Obviously, in this unfortunate time, many companies will now have to cease trading, and an obvious issue with this is what expenses can still be deductible. So one must take into account that for a start, if the company is badly underwater, tax is probably the last of your concerns, and then maybe your last person you want to pay. But for other people, it may just be 2 or 3 bad months, and the tax year is 12 months. So you need to ensure that all your expenses are still tax deductible. So if we go back to our normal principles, when can we claim a deduction? That is, the expense must be incurred in order to produce income, and it must be laid out for the purposes of trade. So one of the issues, obviously, if you are winding up, is your expense still for the purpose of trade, or is it still to produce income? And this can become a little bit tricky. One of the examples that has been recently brought to our attention is retrenchment payments. So obviously there's the statutory minimum amount, And the issue is, what happens if you pay an amount which exceeds the statutory minimum amount? Is this still produced income? Is this still incurred for the purposes of trade? An interesting issue, but we just mainly like to bring up the important issue is that if you are ceasing to trade and there still is tax to pay, just make sure that your expenses are still deductible. Seelan?
Yes, thank you, Hilton. So from a VAT consideration, one of the issues that arise when a company ceases trading is, are they going to deregister for VAT? And if so, what assets do they have on hand? Do they have any trading stock? And the reason why this is important is that there's a deemed supply that takes effect once you deregister for VAT. The VAT vendor then needs to account for output tax on the lower of the market or cost value of the assets, and needs to account for output tax to SARS on the amounts. So it's really an important issue from a cash flow perspective when the decision is taken to deregister. Ashley, can we please move to the next slide? So VAT specific issues that have arisen under COVID, where an important one would be unpaid debts. So generally where VAT vendors are registered on the invoice basis and they haven't paid the amounts due to their creditors within a 12-month period, there's a deemed output tax adjustment which needs to be made. It's a clawback, and the VAT vendor then has to pay back the input tax it claimed, or to the extent that it hasn't paid the outstanding debt, it has to pay that back to SARS. This does not apply to companies within the same group of companies. And I just want to point out that the concept of group of companies for purposes of this specific provision in the VAT Act differs slightly from the income tax provision, in that the percentage required is 100% shareholding and not 70%. So companies should just be careful. It does not apply to connected parties, only to group of companies where there is 100% shareholding. Ashley, can we please move back to the next slide, please? So with the COVID pandemic, the borders were closed, and where VAT vendors export goods, generally they're entitled to apply zero rate VAT, and that's usually subject to two conditions. The one is the goods have to be exported within a specific period, and once the goods are exported, they need to obtain certain prescribed documentation. Now the timelines to export goods is usually 3 months from the earlier of receiving any amount of the payment or issuing a tax invoice, and the period for acquiring the prescribed documents is usually 90 days from export. With the borders being closed, SARS, in anticipation of this, issued a binding General Ruling 52, which has now extended the timelines to export goods by a further 3 months, and by implication, the timelines to obtain the prescribed documentation has also been increased by further a 3-month period. With regards to indirect exports where VAT has been charged, the foreign buyers are given an additional 3 months to claim any input tax charged by the SA supplier from the VAT refund administrator. Ashley, can you please? Sorry, yes. Something not mentioned here, though, is also that a relief has been granted in respect of the importation of essential goods. Now, essential goods are referred to in rebate item 412.11 of the Customs Act, and basically importers are exempted from paying import VAT and customs duty. Something that has come to our attention over the last month or so is that there's a misconception out there that the supply of these essential goods are also exempt from VAT. I should wish to point out it's only the importation, and the importation is only exempt if the importer has applied to ITAC for a permit. So you have to get a certificate or permit from ITAC exempting you from having to account for import VAT and customs duties. Thank you very much. I think we'll now take questions.
Okay, thanks very much, everyone, for staying the course and for sending your questions through. We're going to have a look at some of the questions now, ones that are very specific. We'd rather get back to you on separately, as well as others that are outside of our area of expertise, like labour law and so forth. We won't deal with those. So just with regard, there were quite a lot of questions that people had in relation to the COVID-19 bills. That was the majority of the questions by quite a long way. I'll deal with the ones that have come through now. The one question was about the process for businesses that are more than 100 million. It is, if one goes to the SARS website, unfortunately we're in the hands of SARS for this, because there's nothing in the bills relating, although the minister made an announcement that businesses above 100 million would qualify for relief on direct application. There's nothing in the bills that legislates or is proposed to legislate that process and how it would work. The only information we've got around that is what SARS has put out. And so if you go to the SARS website, you'll see on the home page, you should see the link there. It's under what's new. It comes up quite immediately. The process, the requirements, the email addresses and so forth around applying for relief if the business is more than 100 million of gross income. Another question came through asking whether that gross income is on a taxable income, in other words, a net basis, after taking off all the deductible expenses, or on a gross basis. Look, it is gross income as defined in the Income Tax Act. As I mentioned, also just bearing in mind there's that not more than 20% of the gross income can come from an aggregate of the various passive incomes that are listed in the draft bill. But it is gross income, not more than 100, certainly not net income or taxable income. As I mentioned as well, it's in that one period, 1 April to 31 March, the year end of the business that ends between that time. Trevor had a question, as well as an anonymous one, about VAT refunds and the process, and that they're being sort of stalled, etc. Look, we certainly, thanks for that feedback, and we are going to make a submission on that and include that in our submission on these bills. And I think that's probably the best way of trying to move that forward, that SARS mustn't undermine the purpose of getting the refunds by unnecessarily putting impediments in the way of making those refunds. And I think that would undermine the purpose of National Treasury, and we will include that in our submissions. Peter Lee had a question about 300 million, whether the limit for small and medium has not been increased to 300 million. That's certainly not included in these bills, Peter. It's still 100 million is the limit there. A question, I think it was Senka, who asked about the skills development levy holiday period, and it is a holiday, by the way. It's not a deferral. You don't have to pay skills development levy at all in respect of payroll from 1 May to 31 August. It is a different period from the pay-as-you-earn relief. It's not the same 4-month period, and I think the reasoning there is that the skills development levy was a relatively new benefit that was proposed. It came after the initial proposals for example, the additional employment tax incentive, as well as the pay-as-you-earn relief, and that's why the period is a little bit different and has been moved forward. The skills development levy, and a number of questions about whether that's only applicable to small and medium enterprises. No, it's not. Any employer, regardless of size, will be able to not pay skills development levy for that 4-month payroll period. There's no application process either. It's an automatic holiday that's granted to all employers, that they don't have to pay skills development skills development levy for that 4-month period. Danae, if I could ask you if you could deal with a question that came in regarding the UIF benefit and whether that is, I think Lee asked a question about whether that is tax-free. Sharon?
No problem, David.
If I could just say, your question about being employees being forced to take leave, I think that falls a little bit outside our area because it's a labour law question, so we won't deal with that. And I think, Abel, your question about backdating of salaries, etc., and what would happen, I think, can we please take that one offline, because that's also a very specific question. So Danae, if you could deal with Lee's question.
Sure, and I think, David, for the benefit of the audience, if I could just read the question. Lee had asked, if you get TERS, which is that temporary relief for employees and employers, for an employee, do you have to tax the employee for pay-as-you-earn purposes on the TERS benefit? For example, if someone gets 15,000 Rand from the employer and 5,000 Rand in terms of TERS, therefore you get a combined or accumulate 20,000 per month. Do we calculate pay-as-you-earn on the 15,000 or the 20,000? Now, unfortunately, initially there wasn't really clarity provided by SARS on the TERS and whether it's subject to pay-as-you-earn. However, I think if you see the amount of commentary from tax authors and then apply the general exemptions from income tax, which any type of payment or benefit received in terms of the UIF, the unemployment insurance benefit dispensation, generally enjoys exemption from income tax, one is then can come to the conclusion that any amount paid by the UIF in terms of TERS will not be liable for employees' tax. So, meaning the employer has no obligation to withhold any PAYE, and furthermore, the amount received from TERS should not then be subject to income tax when you submit your personal tax return to SARS. I hope that clarifies.
Thanks, Danae. Then just some other questions, Seelan, if I could ask you. There was a question from Anonymous that came through. Let me just go to it. If you are able to deal with that one, what is the treatment for VAT on export services if there is VAT? For example, the charging of indirect costs, for example, salaries from an entity in South Africa to one in Lesotho. That was the one question on VAT. And then there was another one from Neil about, please confirm output VAT treatment for landlords if tenants do not pay in full. Seelan, are you able to deal with those now?
David, I'd like to take the first one offline rather. It's quite a complex question. With regards to the landlords, I think if you're not issuing tax invoices and your agreements don't serve the same purpose as a tax invoice, then there wouldn't have been a time of supply triggering your VAT liability. Alternatively, you could look at possibly bad debts where your tenants are not paying and are not in a position to pay. You should consider that. But I can also take that offline and contact the person directly. Thank you.
Okay, thanks, Seelan. I think there are a number of very specific questions that have come through. So I think I'm not going to prolong the webinar unduly. I think we'll get back to you on the various questions that have come through. There was one general one that I'll just answer now, I think, in closing. And that is, there was a question about how can one make sure that one's expenses are deductible through this period. So, for example, if one closes the business down temporarily for a 4-month period and so forth, can one still claim those expenses? And I think that the answer, generally speaking, is that one would still be able to claim the expenses because the obligation that's incurred for a lot of those expenses is still that you're trying to produce income, and that they are incurred, they're laid out for purposes of trade because you're hoping to still continue to conduct your trade during the year of assessment. So I would think that the general principle is that those expenses should remain deductible if one is looking to trade. And in respect of salaries and wages that one might voluntarily pay employees who are not able to tender their services during this 4-monthly period, or however long it lasts. I think the principle there would be that one could look to cases like Provider that said that if an amount is incurred voluntarily to keep a happy and contented staff, for when one does continue to trade and generate goodwill for one's staff, that might well be a good argument that one could advance as to that those expenses should then be deductible. But one would have to consider the specific circumstances. So in closing, I'd like to just thank you all once again. We will get back to you on the specific questions that have been asked. And thanks to all the presenters, and I wish you all well. I hope that your businesses continue to stay afloat in these very difficult times. Should you require any assistance from a tax perspective, you'll see our individual email addresses are on the presentation. And I can just also say there have been a lot of questions about whether the presentation has been recorded. Yes, it is. It will be made available on the website. Anyone who participated and attended today's session will be emailed a copy of our presentation slides as well. And if you know of anyone that's not able to make today's session, but would like to possibly join tomorrow evening's live session from 5:30, please would you email BDO, Ashley Trustcott, or any one of us will be able to refer that through, and that person will be able to get an invitation. So thanks very much, everyone, for your participation today, and take care. All the best. Stay safe.